Good morning, everyone, and welcome back to the Daily Hunt for Multi-Backers. It's Friday, May 22nd, 2026, and we're wrapping up a week with some fascinating market insights from yesterday's data.
That's right, Ethan. Our AI dug through a significant number of posts, flagging quite a few different stocks that generated substantial discussion. We're seeing a really mixed bag out there. Some strong bullish sentiment for growth plays, but also some very cautious KPI-driven warnings. It's definitely a dynamic day for market commentary.
All right, let's jump right into it. First up, we've got IBM. Brooke, they just landed a proposed $1 billion CHIPS Act award to build America's first quantum foundry. I mean, this is big. Analysts are already buzzing about a $2 billion U.S. quantum push that could significantly benefit IBM. Plus, insiders have been buying over 310,000 shares recently. That's a huge vote of confidence from those closest to the company. This really could be the long-term pivot IBM needs.
Ethan, I hear the excitement, but let's pump the brakes a bit, While a quantum foundry sounds impressive, this is IBM we're talking about. Their historical revenue growth is a paltry 0.095. Our data shows users are deeply skeptical about IBM's ability to execute on emerging technologies. They've certainly missed out on major tech booms like cloud and AI in the past, and that debt-to-equity ratio, a whopping 211. Embarking on a capital-intensive, speculative venture like quantum with that much leverage is a major red flag. Plus, the PEG ratio at 2.11 suggests the market is already pricing in a lot of future potential that's far from guaranteed. Their previous several ratings were stay away. But Brooke, this is a government-backed quantum initiative. That's not just a speculative startup. It changes the game. It's a powerful endorsement of their technology and capability. It's a long-term, high-risk bet, Ethan. The market and our AI-generated insights show deep-seated skepticism about IBM's execution. While the potential for long-term KPI improvement is there, the current numbers don't support an immediate buy. Our analysis suggests stay away for now.
All right, I respect the caution, so a stay away for IBM this morning. Next, let's talk about IMAX. This one's generating a lot of buzz because the company is exploring a sale. That news alone caused a significant 12% jump in after-hours trading. Users are emphasizing that IMAX's value is in its unique, irreplaceable in-theater experience. And get this, insiders have bought over 257,000 shares in the last 6 months. It's a relatively small acquisition for many potential buyers, and it's never been rated on our podcast before.
The acquisition talk is definitely creating some speculative excitement, Ethan, but we have to look at the numbers too. While that 12% bump is nice, IMAX's revenue growth is actually negative at negative 0.061. That contradicts the idea of it being a moneymaker right now. And its PE ratio is over 50, with a P/B ratio of 5.54. Those are relatively high valuations for a company with declining revenue. An acquisition could certainly unlock value, but we need to acknowledge the underlying operational challenges reflected in those KPIs.
Agreed, but the strategic value of that brand and technology for a potential acquisier is huge, Brooke. The insider buying signals a strong belief in that strategic upside. The immediate market reaction shows there's a strong belief a premium will be paid.
True. The potential acquisition could definitely change those KPIs for the better, making current profitability less relevant than strategic value. The insider activity is a strong positive signal. For IMAX, given the strong acquisition catalyst and insider confidence, our AI-driven commentary suggests a buy. Moving on to SKM. We saw a post from a user who put another $250,000 into SKM, expressing confidence in its long-term potential. The big story here is their stake in Anthropic, with rumors of a new private funding round valuing Anthropic over $900 billion. Plus, SKM's core business showed signs of recovery in Q1 2026, with 89% year-over-year growth in AI data center revenue and a resumed dividend. Their last rating was a cautious buy. Ethan, that user might be bullish, but their detailed analysis was actually very cautious, stating they're not buying the stake cheap and explicitly calling it a directional bet. The stock is trading near its 52-week high, having doubled recently. The PE ratio is a whopping 58, and their core telecom revenue growth is still negative at negative 0.014, with a very low net profit margin. There's also a significant uncertainty about the exact percentage of Anthropic they own, which creates a huge valuation spread. The market seems to have already priced in a lot of that Anthropic upside, and the risks are substantial.
But the AI data center growth and dividend resumption are real positives, Brooke. That shows a turnaround.
It's a recovery off a deep hole, as the post noted, not yet a robust growth engine. For a cautious investor, the valuation is stretched and the Anthropic stake still has too much uncertainty.
Understood. For SKM, our market commentary leads to a stay away classification this time. Now let's talk about a familiar name, Microsoft, MSF. The sentiment out there is overwhelmingly bullish. Users are calling them a definite AI winner and believe the stock is currently oversold. With OpenAI's huge revenue and Microsoft's $1 billion AI partnership with EY, plus massive data center expansion, it's hard to argue against their AI dominance. And the current price is about 24% below its 52-week high, suggesting a great entry point. Microsoft has a strong history of buy ratings on our show, with only a few stay away in between.
Ethan, you know I respect Microsoft's operational excellence. Their revenue growth at 18.3% and a net profit margin of nearly 40% are simply outstanding. And that current price being 24% below its 52-week high does make it look attractive. However, the PEG ratio is 1.3, which indicates it's not exactly cheap, and there's been some minor insider selling. While the AI news is certainly exciting and has the potential to keep those KPIs strong, we have to consider if the growth is fully reflected.
For a company with this kind of fundamental strength and leadership in a booming sector like AI, that slight premium is often justified by future growth potential. All signs point to continued expansion.
Agreed. The long-term outlook remains strong, and the current price offers an attractive entry point given its trajectory. For Microsoft, MSF, our market commentary is a strong buy. Next up, we had a lot of discussion around PDT, John Hancock Premium Dividend Fund. This was all about the upcoming pattern day trader rule change, removing the $25,000 restriction. Users were really excited about the increased trading freedom, and that's generally good for brokers, right? Plus, the company itself has seen some insider buying recently.
Ethan, we need to clarify this. The vast majority of user discussions we analyzed were solely about the pattern day trader rule change and its impact on individual traders, not the company with the ticker symbol PDT, which is the John Hancock Premium Dividend Fund. For that company, our KPIs paint a very concerning picture. We're looking at an incredibly high debt-to-equity ratio of over 54 and abysmal net profit margins at 1.16%. Their operating margin is even lower at 0.83%. Yes, there's a high dividend yield, but with those kinds of profitability issues and debt, that dividend might be a classic value trap. The rule change for traders doesn't magically fix this company's financials. It's consistently been a stay-away rating for us.
That's a crucial distinction, Brooke. A stark reminder to always look at the underlying business, not just the buzz around a ticker.
Absolutely.
So for the company PDT, John Hancock Premium Dividend Fund, our AI-generated analysis concludes with a firm stay away. All right, moving on. We saw some activity around SKT, Tanger Inc. It's a real estate investment trust, known for its outlet centers. They've shown solid revenue growth at 11.7% and excellent operating margins over 30%. Recent news highlights record leasing growth and strong growth in core FFO in Q1 2026. Plus, they're flagged as a great dividend stock, and insiders have been buying a significant 14% of their total shares. This is strong operational momentum, you know?
Hold on, Ethan. The user posts that flagged SKT were actually discussing SK Telecom, SKM, not Tanger, SKT, so the social sentiment isn't directly relevant to Tanger here. Focusing on Tanger's KPIs, yes, the operations look good on the surface, but we have a very high debt-to-equity ratio at 280.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in, everyone. We'll catch you next time for more market insights.
Have a great rest of your day.